But yeah, so to start off becoming your own bank, this is a concept utilizing an IUL. An IUL is IUL, and forgive the handwriting, folks, but an IUL stands for Index Universal Life. All right, so index UNIVERSA. All right. Index Universal Life Insurance Policy. All right. So an IUL stands for Index Universal Life Insurance Policy. So when it comes into life insurance, a lot of people are not aware that you can utilize life insurance policies while you're living. Now, this is what I personally have. I have a term policy and I have a whole life policy. There are four main types of life insurance policies, and I'll go over those briefly real quick. So first one, you have the IUL, then you have your whole life. All right. Then you have your term life. And then you have your A, D, and D. All right. So I'll go over each one of these real quick, briefly, so then we can go over the IUL and how to become your own bank utilizing the IUL. So first you have your A, D, and D, which stands for accidental death or dismemberment. Let me make sure that that is in screen on camera. It is. All right. So A, D, and D stands for accidental death or dismemberment. Now, what that is, if you pass away due to an accident or if you lose a finger, and it matters how much finger you lose or how much limb you lose, that policy will pay out. Banks or credit unions usually gives those out for free or at a discounted rate. All right, so oftentimes people come to me saying, yeah, I already have $1 million policy and I'm only paying $2 a month. Immediately in my head, I'm over here like that's probably going to be an accidental death or dismemberment. Now, in the world of life insurance, we really particularly don't count that being a life insurance policy because those get added on to either a term life policy, a whole life policy, or an IUL for a discounted cost, sometimes for free. So that's accidental death or dismemberment. Then you have your term life. Your term life is one of the most popular ones. A lot of folks out there get term life when you're younger because the price is super low. You're only paying for one thing. You're only paying for the cost of insurance. Now, popular companies out there that only sell term life is going to be, one popular is going to be Primerica. Primerica only sell term life policies. All right. Now, the difference between a term and a whole life, a term life policy, it does exactly what it says in the name. It is temporary. All right. I'm just going to abbreviate because me and spelling don't make really good, we don't have a really good relationship. But term life stands for temporary, or it will terminate at a certain point of time. So this is what I always educate folks when it comes to the Primerica policies, is that they are going to last, particularly usually till someone reaches the age of 85 years old. All right. Now, which is good. Sometimes you might have one that reaches up to the age of 95. But what they don't really discuss or even highlight is that with those type of policies, they have a maturity date. And that maturity date is usually at age maturity date or year is usually at age 70, 75, or 80. All right, there's a lot of companies that have term life policies, but once someone reaches the age of 70, 75, or 80, that's when that policy will either terminate, that means that you don't have that policy anymore, or that means that the price will start going up at that point of time. Even if it says it'll last till 85, which it will, that means from the years of 70 to 85, that price will continue to rise on either a yearly, 2-year, or 5-year basis based upon the carrier and based upon the term as far as what's within the entire policy. That's term life. Good thing is that you can get a super high face amount. Bad thing is that for that face amount to actually pay out, you have to pass away before the term ends. If you don't, then you don't get anything out of it. There are these type of policies, term life policies called ROP, which stands for return on premium. But you have to medically qualify for those. And typically, when I get people who qualify for those, they are young, they are healthy, and they are in shape, not even close to being overweight. We're not even talking about being obese. We're not talking about being underweight. We're talking about a BMI score of around like 23 to 25 at most. All right, but it all comes by qualification, so that's going to be term life. Then you have whole life. Whole life is going to last you up until you reach the age of 121 years old. Okay? Woo. All right, 121 years old. Now let me put some lines here so you guys can see it as I'm going. There we go. So whole life lasts up until the age of 121 years old. So that's why they call it whole life. I don't know if anybody's watching this, but if you met somebody who's reached 121 years old, I want to speak to them and I do want to draw their blood, because at that point in time I believe that they are a vampire. So I need to figure out what's really going on. All right. So now whole life, you're going to be paying for two different things within your premiums. Your premiums are what your monthly cost is. You're going to be paying for the cost of insurance. All right. And then you're going to be paying cash value. All right. So those are the two things that you'll be paying for when you're making your payments towards your whole life policy. Now, good thing, or the difference. So term life, you are only paying for the cost of insurance. That's why the price is lower. All right, you're only paying for the cost of insurance. With a whole life policy, you're paying for the cost of insurance and cash value, where that can be seen as equity within your policy. Now, the cost of insurance for any of these policies goes up as you get older. Okay, the cost of your insurance goes up as you get older. Every single year, your cost of insurance is more. And then your cash value will always continue to grow as you're making your payments. Now, when we're talking about an IUL, so this is just the basic stuff, okay, guys? This is just really the basic stuff. So an IUL is a hybrid policy. You take the low cost of insurance from a term life policy, then you take the cash value account from a whole life policy. You mix those two together, you get an IUL, an Index Universal Life. All right. Now, the word index comes from where your cash value, account is tied to a stock exchange or stock index. All right. Most of the time, stock index is chosen is going to be the S&P 500. So now, why is this good? Why is it bad? What really makes this? How can you become your own bank with something like this? All right. So when you have your cash value hedged with the stock index, you're able to participate in you're able to participate in the gains of the S&P 500 rather than the losses, because you're protected by a 0% loss, and that's just within the insurance contract. All right. Now, S&P 500, particularly on a yearly basis, they have a cap rate, they have a max rate, things like that. Again, we're just going over high level of this so you can get a basic understanding. And if this is something that you want to learn more about, please, you have to do one thing. I can go over in detail with you as far as what's going to be particularly best for you in your individual situation. You have to book a call with me using my link, and it is in my bio. It's on my Calendly link. I have all my availability up in that link, and if you don't book it, then we can't talk. Right? I can't teach all of this within small 30-second videos or even on a live. So I'll be going live on a continuous basis, really building out what we have going on here. All right. So the S&P 500, now this is particularly what we usually put it with, all right? So let me get my eraser, handy dandy eraser, all right? So I hope that we have a basic understanding of the different types of life insurance, okay, before I erase this. Term life stands for temporary. It's good when you're younger because the price is low. All right, but once it gets to the maturity age of that policy, typically it's going to be 70, 75, or 80. That price will either continue to rise on a yearly, 2-year, or 5-year basis based upon the carrier that you chose or based upon the product that you chose. And then some popular companies, one is going to be Primerica. They only sell term life policies and are not transparent about what that means. Because once someone reaches the age of 70 or 75, that price will go up on a yearly basis. And if the person knew about that in the first place, they still probably would have gotten that term life policy because they offer some really good terms, some really good prices. But they would have gotten a whole life policy to combat that price going up and up and up. Because with the whole life policy, the price stays the same for 121 years, all right, or up until you reach the age of 121. You're paying for two different things with a whole life policy: the cost of insurance and then the cash value account. The cash value account, there you grow equity within your policy and you're able to take a policy loan whenever that you want. No questions asked. You don't have to worry about a credit check. You don't have to show bank statements or anything like that. All right. And then when it comes into an IUL, you take the low cost of insurance from a term life policy, and then you take the cash value account from a whole life policy. You mix those two together, you make a baby, you get an IUL. Now we're going to be talking about how to become your own bank utilizing an IUL. So let's go ahead and erase this real quick, and I'll just make another, just write out another word for IUL up on it. All right. So here, IUL. IUL. And then to note, there is another thing called a universal life, but universal life really stands for adjustable premiums. Your premiums go up, they go down, but you're not able to have your cash value account attached to a stock index. All right. So an IUL, when you have it set up correctly, your IUL can last you for a lifetime. All right, when I say set up, structure correctly, because when you're speaking with an agent like myself, I'm going to be asking very particular questions as far as what is your goal, what is the purpose of this policy. Some people want the purpose of their life insurance policy just for the death benefit. All right. Now, if someone wants a life insurance policy, particularly just for the death benefit, for a high death benefit, right, I may recommend them getting a term policy because they're probably going to get, not even probably, most likely going to get a higher death benefit with a term policy for the price that they're paying. But if someone wants it to last their whole life or their entire life, so I won't get the words mixed up, all right, if they want their life insurance policy to last their entire life, all right, without the price changing, then that's when I would recommend a whole life policy. All right, I hope you guys are seeing the difference. Now, if someone's looking for low cost, well, then we have to really figure out their age, their health, their habits, because when it comes to the different types, that changes things, all right? Again, high-level view of just the IUL. Now, let's say, for instance, someone wants to utilize cash value, all right? Then that's when I'll be speaking about the IUL or whole life. Now, a lot of folks or a lot of agents actually mislead people when it comes into an IUL. They say an IUL, Index Universal Life Insurance Policy, is an investment. It is not an investment, okay? Reason why it's not an investment, because you cannot see super big upsides, but you can utilize it while you're living to use it for an actual investment. This right here in IUL, how I utilize it, I am becoming my own bank when I'm using my IUL. So a lot of different reasons, and I can keep going with these different reasons, but this is particularly where people fall in line. Or someone said, well, death benefit, of course. Now, IUL, going into the index, how to become your own bank. All right. So a lot of carriers out there. We have Mutual of Omaha, we have F&G, we have Transamerica, we have Americo, American Amicable. We have a lot of different carriers when it comes into obtaining an IUL, but the underwriting is usually all going to be the same. No DUIs, all right, clean driving record, no felonies in the past, a good bill of health, all right. See what else. You have stable income for some of them. So there's a lot of different underwriting questions, but when you and I are having those one-on-one conversations, we're going to ask all of that before I even get to going into the different carriers. All right. So me as a broker, I have access to all of the carriers rather than just one. So I'm unbiased when it comes into the carrier. All right. We work for you and only you. Now, an IUL index. All right, index, and I've got my computer right there as well. So index. Now let's say you chose up on your IUL the S&P 500. All right, so you get to participate in the yearly gains every single year. All right, and let's say your cap rate, again, these are just words that I'm using. These are just ranges. These are not the actual case. This is not the actual one, but we're just going on averages, yearly averages. All right, cap rate, top rate, all that stuff can change, but we're just going to use the basic. All right, so you have a cap rate. All right, cap rate means that if the S&P 500 goes up that year by 10%, and your cap rate is set at 6%, you're participating in 6%, not 10%. That's not a bad thing. That's just how they have it structured, okay? So cap rate, let's say that the cap rate is set, and I usually see this on some of the IULs at a 8% cap rate, all right? Now, the S&P, for the past about what I've recorded, for the past about like 20 years, this is why I usually use the S&P unless someone wants to go to an aggressive strategy. The S&P 500 is going up on a 6% basis, all right, on average, all right, because usually it's been sitting anywhere between a 5 to about a 8%, all right, in like the past 20 years. You can fact check me, please do. Then you might see that I'm going to be saying everything correct. All right. Now, S&P 500, we're going to tie your cash value account to this index. All right. We're going to tie it to this index. Now, let's say, for instance, and I'm going to use my example that I use all the time so I'm not getting numbers mixed up and I can be pretty efficient with how I'm going about this. All right, let's go to my notes. See which one. I know it's not going to be there. All right. As I'm looking this up real quick, let me see if I have any questions. Any questions? Anything like that too? Hey, I see Lance up here. What's happening, Lance? All right. Onboarding. Nope. Okay, I'm getting closer. There we go. All right. Let's go and use these numbers here. Here we go. Previous 30. All right. I think I found it here. Perfect. Here we go. All right, so we're going to be using these numbers, okay? So here, S&P 500. Now, let's say, for instance, here, you have a cash value account. You built it up over the years, and your cash value account is sitting at a even $100,000. That means that you paid your premiums on time and you overfunded it properly. All right, again, broad terms. You overfunded it properly, and you have it with the S&P 500 going to 6%. Okay. Now, you want to take a policy loan. Let's say, for instance, you want to take a policy loan out on your own money. Let me make sure that this is still on the screen. It is. All right. That you want to take a policy loan out on your own money. And you have your loaned amount of money, and you have your unloaned amount of money. Let's say you say, hey, I want to take $50,000 out of my cash value account. Awesome. $50,000 is left in your cash value account, and then you have 50,000 in your loaned account. Okay, I think we're following here, everybody. So now here, this still grows at 6% because you never touched it. 6% of 50,000 is going to be 3,000. All right, we want to bring this back into the equation later because you never touched this 50,000. You're still earning 6%. All right, now let me go ahead. I'm gonna check my math on it because math always be mathing when it doesn't math. So 50,000 times 0.06 for 6%, 3,000. Perfect. All right. Now, after you get that, let me go back to my notes. Perfect. There we are. All right. So after you have your unloaned money still gaining 3% or 6%, then you have your loaned money, your 50,000. All right, because you loan 50% of it, this is growing at a 3% basis as if you never touched this money. All right, this is still growing. This is still growing, folks, even if you have it out of your account. So this is where it becomes really lucrative when you're using the money for an actual investment like real estate, like starting a business, like doing a rental car company. Some of my folks are doing that. All right. Now your loan money does have an interest rate that you have to pay back. Okay, I want you guys to follow me. Whenever you're taking a policy loan, whether it be a whole life policy or an index universal life policy, this is something that some advisors, some agents don't really speak about, and I always do. If you take a loan out on your money, there is an interest rate attached to it, and you must know exactly what that is before you do it. Because if you don't pay it back, that policy will start to implode on you, and then it will lapse later on. But remember, coming back to here, your 50,000 is still earning 3% because that's how the IUL is structured. But your policy loan is set at a 4%. All right. Now, if you are gaining 3% of your own money and then you have to pay back 4%, that means that your loan is actually a 1% loan. All right. I know I posted a video some time ago, maybe 3 weeks ago, saying that you can get a 1% loan on your own money. This is exactly how. You didn't have to do a single credit check with this. You didn't have to put out a single bank statement with this. This is how you're able to get a low percent, 1% loan out on your own money. Banks don't do 1% loan unless you have like a 800 type of credit score. A lot of folks don't have that. Some people are within the 500, 600, 700 range. They're not able to get a 1% loan. But let's keep moving. All right. So now here we're going to go next you have your money that you have not touched with your $50,000. You have $3,000 earned in interest because of that 6% right there. All right. Now, let's add it all up. Now, you use this, you put it towards an investment, you got your investment money back, you got your profit, and then you're able to pay back that full $50,000. All right. $50,000 coming into play. We got to add it all up. So here we have to do right here that these two together, that's going to be $53,000. All right, because you have earned 6% from it. And then you add, now I want you guys to look at this, 1% of 50,000. What is that? What is that? All right, go ahead and pull out your calculator. I'm going to do it right here with you. 50%, 50,000 times 0.01 is equal to 500. All right, I already have my notes, but literally I can show you that I'm doing it right here with you. All right, so that's 500. So that means you took a loan out on your own money, all right, and you earned $500. All right, you just earned $500 from taking a loan out on your own money. So with this right here, that's going to be 50,500. All right, and now you add these two together. You're going to be left with, I love this math. I'll do it right here with you. This is by taking a loan out of your own money, becoming your own bank, and this is how you become your own bank. All right, 53,000 plus 50,500. That's equal to $103,500. Because you took a loan out in your own money from the very top. You earned $3,500 because of the participating loan that you had with the 6% still earning interest on the unloaned money, and then 3% earning interest from the loan money because that's how the policy is set up. And then with the 1% loan, because you have to pay back 4% off of the loan that you took out, which equals up to that 1%. 3 minus 4 is equal to 1, which is equal to 50,500, all right, that you have to pay back, all right? You have to pay back. Bam, you add the 53,000, the 50/50, now like the 5,500, which equals to 103,500, $103,500, all right? This is how you are becoming your own bank. Not even to mention what you used this $50,000 on that investment vehicle for. This is how the infinite banking, becoming your own bank strategy actually works. I have an IUL out on my for myself. All right, and IULs, when it comes into the price that you're paying, it's all based upon one, your risk tolerance as far as the money that you want to put in and how much cost of insurance you want, and then your outlook on where you want it to land at a certain year. All right, so that's where, when it comes into speaking on a one-on-one basis, we're really having those discussions. We're really asking, what are you looking for? When are you looking for? How much? What is your budget? What is your top line budget? So then we can look everywhere up underneath it. All right, we're not going to go above it. We're going to structure your IUL properly. Because sometimes when you're structuring the IUL properly and you're young, it may not be favorable for you to get a super high cost of insurance. Because the high cost of insurance is going to cost you more up on the front end, and then later on it'll start eating away. So maybe a lower cost of insurance may be better when you're getting your IUL, because you're able to overfund it a lot better. And then we'll go into a little bit more about that. But this is the concept of becoming your own bank and utilizing your own money and earn money at the same time. Having a 1% loan. the longer that you have actually had your life insurance policy with an IUL, depending upon the carrier, this loan can be 0%. This loan can be 2%. This loan can flip it, and you are really starting to, it makes more sense for you to take out a loan on your own money, because you're going to be gaining at the front end rather than doing a 1% loss, but still, when you pay it back, you're still earning more money. So this is what a lot of folks do when they don't have equity within a house. All right, you can build equity within a life insurance policy and do the same exact thing. You can look at a life insurance loan being a HELOC, a home equity line of credit. All right, many different things. I can go over this over and over and over again. Let me see if we have any questions or anything like that. So now I just went over everything again. I'm going to be cutting and screwing this up. I'm going to have this up on my page sometime soon, as far as how I broke all of this down. Now, when we're talking about becoming your own bank, you're utilizing a life insurance policy called an IUL, just as long as you're able to qualify for it. And qualifications is based off of your age, your health,